This is how investors think. This is how all investors think. And if you don't think that way, it is time to start. This is going to help you compare different investments of different potential maturities. And without annualizing it, it's just going to be very, very confusing.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 77, the metrics I use on wheel trades and how they work. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. First, make sure that you're subscribed to the show in your favorite podcast app. And if you're already subscribed to the show, you can go even deeper and get more with a paid subscription. With your paid subscription, you get video extra podcast episodes so you can get hands-on video training on things we talked about on the show. Subscriber-only posts where I drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash secured put trades that I'm making. You'll get access to our monthly online Ask Me Anything webinar, our unusual options activity alerts on income trades. And the best part is your paid subscription helps to keep this show on the air. And we all like that, right? As you probably know from listening to the show, the idea of this podcast has been to parallel the content in my book, Build Consistent Wealth with Options. Every week, I open the next chapter or part of a chapter and grab inspiration from it and talk about the examples in the book. In today's intro for this show, to segue into what we're about to talk about on the show, I'm supposed to talk about benchmarks. And it's funny, but I was already primed to talk about benchmarks today. I had a one-on-one coaching session with one of our student traders. You know who you are, Ryan. And he was asking, what should I be shooting for in my option trading? Should I try to beat the 4% money market rate I can get? Should I be trying for more to beat the S&P 500? What? Well, first, I'd like to say that is just the way a trader or investor should be thinking. That which is measured is improved. We need a benchmark to measure results against so that we can strive to beat it. Competition makes humans better. And the other side of that story is that we should always think about our trading as a business. Even if it's just something we do for an hour or two a week, we take it seriously and we care about results. We could invest our money in many different things. Our trading business is just one of them. There's a business out there called State Street SPDR ETF, better known by its trading symbol SPY. That's right, the Spiders ETF. The ETF on the S&P 500 divided by 10. We can easily invest in that business. It's super easy. And if we did, history shows we'd likely earn an average of 10% a year over the long haul on that investment. If I can't earn that in my own trading, why would I invest in my trading business instead of simply buying a piece of the Spiders ETF? It wouldn't make sense. So yes, for an investment benchmark, the market or the S&P 500 is a good one. And if you can beat it consistently, you've carved yourself out a nice little business. But the devil's in the details. If you're a runner, let's say, you don't just measure how fast you can run the course or whatever it is. If you want to improve, you've got to measure some other things. Time spent exercising, reps, hours of sleep, calories consumed. This is how you get better at the big picture, the thing that matters. That's how you get faster relative to your competition, i.e., the benchmark. And that's just what we have with the wheel. When we measure certain things, we can learn from them, we can improve from them, and we can ourselves get better at running this business that we call trading the wheel. There are a few important things to keep in mind about some of the metrics that we talk about on the show and that I covered in the book. So I have some notes on some of the metrics that I think are really important and are often used less than ideally by novice wheel traders. One of the first things that any wheel trader needs to do when you're trading the covered calls is to calculate what we call the static return. The static return is a calculation that we talked about many shows back by now, but you should remember it because it's very important. It's when we're trading a covered call, we take the call premium and divide it by the stock price. Here's the idea behind that. With any investment, we always want to know what our percent profit is. I mean, that's the whole idea behind making any trade or investment. What is our percent profit? So we take the potential profit and divide that by our investment. Now, the investment is the stock. And we always want to look at it at the time of the trade. So if the stock is trading at $132.17 at the time we sell the call at $1.52, we divide $1.52 by $132.17. Now, if you think about that a little bit, it's kind of weird because if I did the calculation 5 minutes earlier, well, the stock would be a slightly different price. Maybe the call would be a slightly different price. And the call's not my maximum profit. It's my maximum profit potential. And I'm probably going to close that call before expiration anyway. And that's only measuring the option. The stock could go up and I could make even more profit on the stock component, or it could go down and I can lose on the stock and I can lose even more than I could make on the call. In some ways, it feels like it could be maybe a flawed metric. But it is one metric that we can hang our hat on. And that does give us some very useful information. What it tells us is if the underlying stock doesn't move, this is the most I can make during this period between now and expiration. So let's start out talking about this if the stock doesn't move bit. Well, the stock's going to move. Which way is it going to move? We don't know. Is it going to go up or down? I mean, if you do know the answer to that, send me an email. I've got a business opportunity for you. We don't know. But the one thing that we do know by looking at the log normal distribution, which is what academics believe stock prices adhere to once we account for leptokurtosis. The thing we know is that the most likely scenario is that the stock is going to be trading pretty close to where it was when we put the trade on. Technically, plus the interest that would be earned between now and then based on some metric. We could consider it the risk-free rate. We can consider it another rate. You know, we don't want to get too nitty-gritty. But smaller moves are more common than bigger moves. Since we don't know where the stock is going to be, it's actually very reasonable just to assume, okay, it's going to be trading right here at expiration. Now, obviously, we've got to do some other calculations if we want to develop realistic expectations. But we're going to start with this. This is an important one. One thing to remember about this covered call metric is that only time value and not intrinsic value are important. Let's talk about that. The whole point to covered calls or cash cured puts is the premium paid over parity. That is the factor that is a function of supply and demand. That is the thing that is a factor of implied volatility changing. That is a factor that contributes to this idea of the risk premium, that options are overpriced in the long run. Intrinsic value can't be overpriced. Intrinsic value is just how much it's in the money. So we only look at time value when we're calculating static return. Another thing is that in practice, debits paid for closing orders, they have an impact on the actual return. So in reality, we have to take that into account. Still, another thing that we have to take into account is if I'm getting in the habit of calculating my static return, which if I'm going to be good at the wheel, I better get in the habit of calculating my static return. I'm going to be doing it probably every day or every time that I look at a trade or potential trade, whether I have it on or I'm considering putting it on. If there's 4 days today, there's 3 days tomorrow, there were 5 days yesterday. If I do the calculation today or tomorrow or the next day, well, it's going to be a different return, right? Because options decay in value as time passes and the stock price changes, implied volatility changes. And if I'm comparing this covered call opportunity against that covered call opportunity, and they have different days to expiration, or there's any different criteria, stock price, option price, implied volatility, well, it's kind of apples to oranges unless we annualized the returns. Investors are used to thinking in terms of annualized returns. Look, when you go to price out a bond, okay, maybe it's a 10-year bond. Well, they're going to tell you what the interest payment over a year period is. They're going to tell you what the annualized interest payment is. They're not going to say, well, over 10 years, you're going to make, 47%. You're going to say, oh, it's 4% coupon per year. If it's a 2-month T-bill or something, they're not going to tell you what interest you make in 2 months. They're going to tell you what the annualized yield is. This is how investors think. This is how all investors think. And if you don't think that way, it is time to start. This is going to help you compare different investments of different potential maturities. And without annualizing it, it's just going to be very, very confusing. How do we calculate the annualized yield? Simple. We just take the static return, so the call premium earned, divided by the stock price, and we multiply that times 365 days in a year and divide that by the calendar days to expiration. That will give us our annualized yield or our annualized return. And that is exactly what we need for analyzing and comparing two different trades. And that becomes super powerful because now we can think of not just our wheel trading as a business, but we can think about each trade as sort of, let's call it a subsidiary of that business. hey, on this trade, I can earn a 12.7% annualized return. But there's this other trade that I can earn a 15.1% annualized return. Doesn't matter what the days to expiration are, the time horizon, or anything. It doesn't even matter if it's another covered call. It could be a bond. It could be anything. Now this becomes powerful. Now, as a caution, sometimes with looking at the annualized yield, especially when a stock has a higher implied volatility, you can look at it and say, holy cow, man, I can earn a 42% annualized return. The point of this is not to get all excited about it or to, stroke your ego and think, oh, I'm so smart, I can earn a 47% annualized return. Look at me. No. Because you know what? Not every trade wins, right? In the aggregate of trades, it's effectively a percentage of annualized returns of all the trades that you make that end up in your pocket at the end. Also, with covered calls, we want to use the if called return. That is basically a conceptually similar idea, but we're not making the assumption that the stock doesn't move. We're going to make another assumption about the stock price, that the stock went up and went above the call strike, and the call got assigned. The stock got called away if called. Get it? If I do both the annualized return and the if called return, now I'm seeing a much broader picture. And I'm seeing some really important stuff. Because I'm looking at, if I don't get assigned, I get this. And I know that the stock can go up or down, but that's going to be a different factor that I can take into account. But if I do get assigned, then I get this. And that's actually a lot more clear, because whether the call is a penny in the money or $50 in the money, the calculation is the same. So in some ways, it's an even more useful calculation. It's just different. So the if called return, we're doing something pretty similar. We're saying if the stock rises from where it is now to the strike price, I'll make this on the stock, so strike price minus stock price, but I'll also make that call premium, so potential profit on the stock plus the call premium, divided by the stock price at the time of the trade. So that's going to be a bigger number. Now we're looking at, if I don't get assigned, I basically get this. If I do get assigned, I get that. Now, whether I have the skate objective or the trade objective, I know just because it's my objective, it's not actually going to happen. So I can say, oh, if I meet my objective, this is what happens. If I don't meet my objective, that's what happens. These calculations, they're just essential. They are just essential. Those are calculations that come with the covered call part of the wheel. But the cash secured put part also has some pretty important stuff as well. And they're pretty similar to the covered call calculations. And in some ways, they're actually even more useful. Now, you know me. I'm a little biased to the cash secured put. I think cash secured puts are even a more powerful tool than covered calls, even though, hey, I know you're going to tell me, Dan, didn't you tell us they're synthetically the same? Well, yes, they are, but we use different strike prices. So there. The first calculation we want to do with cash secured puts is the skate return on cash. And this is conceptually equivalent to the static return calculation, but it's a little nuanced. It's a little different. And in some ways, it's more accurate. And in some ways, it's more useful and more powerful. So the skate return on cash we get by dividing the put time premium. Again, we don't want to use intrinsic value. We only want to use the time premium. We divide the put time premium by not the stock price, but the strike price. This is mainly a starting point. It's going to be more useful when it's annualized. But before we get into that, let's talk about why I just love the skate return on cash calculation so darn much. When we're doing the static return, one of the flaws there is, hey, we don't know where the stock's going to be, so we'll just assume that it's at the same place it is now at expiration. And we know that's going to be wrong, but it's the best we got. With the skate return on cash, what we're doing, we're dividing our potential profit by our investment, and the strike price is our investment. Make no mistake about it. No bones about it, as they say. The strike price is our investment. How? Why? Because it is a cash secured put. The potential of buying the stock because we get assigned on the put is secured by cash that our broker kindly doesn't let us touch. It sets it aside to a different part of our account, and we can't use it. It's in margin. It's locked up in margin. So it's almost like we're paying for the stock because we kind of are. I mean, technically we're not, but it's one of those things like people say if you have a mortgage, the bank owns your house, which they don't. You own the house, but stop paying your mortgage and see what happens. It's kind of like that a little bit, right? I have money in my account. My broker takes it and sets it aside and won't let me touch it. For all intents and purposes, it's gone for me for now until I get assigned, and then it's still gone because my broker uses it to pay for the stock. Or when the put expires or I close the put, then my broker says, here you go, you can have it back. For all intents and purposes, I'm basically paying for that stock now. And what price am I paying? The strike price times 100 shares. So in a lot of ways, the skate return on cash is a much more accurate interpretation of return on investment than static return because it's very exact. And that becomes so powerful. I've talked about on the show before, with this calculation, you can think about your cash secured put as a bond. Weird to think about it that way, but you can. I put on this trade, and if I hold it till expiration and I don't get assigned, this is the interest rate that I earn on this cash. Exactly calculatable. But like a bond or any other investment, we got to annualize it. And this is what we call the skate yield. Our skate return on cash, once we annualize it, we call it the skate yield. This annualized version of the skate return on cash, it might be the most useful metric that I put in the book. It might be the most useful metric that I talk about on this show. Why? No, like I said, because it gives extremely valuable information of what the merit of this trade is as an investment in and of itself. I can compare it to any other investment, a different cash secured put, a different covered call, a futures play, a bond, a CD at my bank, any business. But it has some understated psychological benefits as well. For one, it emboldens put sellers to sell closer to the money strikes. Interesting, right? A lot of novice wheel traders that I talk to, they're so afraid of getting assigned that they sell way out of the money puts that are so far out of the money that they collect so little on their cash investment that they earn a terrible return on their risk. Measuring the risk as a standalone investment, it makes it easier to remove that fear, maybe not remove the fear, but think through the fear and think, well, even if I don't want to get assigned, I mean, if I earn this lousy return and I still get assigned, I made a horrible mistake. I know I might get assigned. I might as well make a decent return on investment, because at some point, all trading and investing is about risk reward, right? Hey, here's the rate of return that I can make. I know that even if I don't want to get assigned, I might get assigned. That's what I'm perceiving in my mind as risk if I have that skate objective. But geez, if I can make a 37% annualized return over this 5-day period, and there's a lot of support underneath the market, it's worth taking that risk in a hypothetical case. In some cases, it might not be, but this makes it possible for you to make better decisions and replace fear with solid numbers. The other mental benefit of skate yield is it helps overcome the trap of price anchoring. It's really difficult for any human to sell a $5 out of the money cash secured put, say like the 85 strike, and watch the stock gap up to $120 and think nothing of selling the 115 puts. It's more like, I can't risk paying $30 more for the stock than I could have paid last week when it was at 85. If I get assigned, I'm buying the stock at a lofty nosebleed price. In reality, if it's still an attractive skate yield, an assignment is objectively acceptable based on technicals or fundamentals still at this price level, there's no reason not to consider the trade. The numbers don't lie. But you know who does lie? Investors. Investors lie to themselves. The skate yield helps keep investors honest. I'm looking at where we are in our notes, and I think that the best course of action here is to break this episode into two. I think that would be pretty logical, because I don't think I could get through the rest of the stuff here in the time that we need. So next week, we're going to do part 2 of our metrics. And that about wraps it up for this show. But before you go, make sure that you are subscribed in your favorite podcast app. And please leave a comment. Let us know what you think. If you're on your phone on Spotify, all you got to do is just scroll down on the episode, and there's the notes. You can leave a comment right there, and I would love to hear what you think. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.